At this exact moment, you're living in two economies at the same time. In the first one, everything is booming. The stock market just closed at another all-time record high for the 26th time this year. And in the second one, which is the one you actually live in day to day, rent is eating away at your paycheck before the month even starts. A weekly shop costs double what it used to, and owning a home is starting to feel impossible. Then when you add inflation, wars, fuel shortages and outright chaos, it raises the obvious question. How can stocks keep hitting record highs if the world is so, what's the polite way to put it, broken? I've been investing for over 40 years and made millions in the process, so let's break this down properly, and by the end, you'll understand what the stock market actually is, why it keeps breaking records, and how you can get on the right side to benefit from it. One of the biggest myths around money is that the stock market and the economy are the same thing, but they really aren't. And if you thought they were, then it's hardly your fault, because it's drilled into us from every direction. When the market goes up, people make out like it's an amazing day for the country, and when the market goes down, people assume the country is failing. For some reason, which definitely has nothing to do with the fact the system wants people to stay poor and work until they die, this stuff isn't taught in schools. So let me put it as plainly as I can. The economy is jobs, wages, and the price of a loaf of bread or a tank of gas. It's essentially how real people are doing and how affordable the things they need in their daily lives are. The stock market, on the other hand, is the value of shares in publicly traded companies and how those investments are performing. So when the stock market is hitting all-time highs, that doesn't necessarily mean ordinary people are getting richer or that life is becoming more affordable. In fact, both things can happen at the same time. And that's why looking at the stock market and saying the economy's doing great can be completely misleading. The biggest companies in the world can become more valuable by cutting jobs and raising prices, which are the exact two things that make the economy and your life worse. But when this happens, you can bet your last tenner that the stock will go up and the shareholders will get richer. Just imagine for a moment someone won the biggest jackpot in lottery history and everyone is told to go out and celebrate together because we all did it, we all won. Except in reality, the only person who should be celebrating is the one who bought the winning ticket. That's not an exaggeration of how stock ownership works. It's actually pretty much exactly how it works. The top 10% of households own the overwhelming majority of all stocks, and the bottom half, which is tens of millions of people, own almost none of it. So when the market rallies and adds trillions of dollars in a matter of weeks, the money flows entirely to the people who already own the assets. The rich get richer in their sleep, and everyone else reads about it over breakfast while being told to feel good about the country thriving. Now, let me get one thing straight. I've always believed in capitalism and understood how all of this worked from a very early age, which is exactly why I make these kinds of videos across both of my channels. So fine, the market makes a small group richer, but I know some of you are thinking, all right, Mark, but that still doesn't explain why stocks are booming while the news is terrible. And I hear you. The world is a scary place at the moment. We're dealing with layoffs, wars, crazy inflation, despite inflation apparently not being crazy. So to understand why the market still climbs, you first need to understand what the market actually is, because it's probably not what you think. The mistake most people make is assuming a stock's price is a measure of how the company is performing right now, when in reality, it's nothing more than a bet on the future. Let's say you have an exam coming up that everybody, including your parents and teacher, thought you would fail. Then results day comes and you barely scrape a pass. By any normal measure, that's nothing to write home about. But up against what everyone expected, it feels like a reason to celebrate the win, if you can call it that. Markets do a similar sort of thing every day. Bad news that turns out to be a little less bad than everyone feared can send a stock flying because the fear was already baked into the price days, weeks, or even months ago. Take the company Workday, for example. Earlier this year, investors were worried that AI competitors would seriously disrupt its business. Then the company reported better than expected results and the stock jumped around 5% in a single day. The business didn't necessarily become 5% more profitable. Investors were just less worried about the future. The market isn't reacting to bad news. It's reacting to the news versus the expectation, which is one of the reasons we see these strange rallies in the middle of bad economic headlines like this one, this one, this one, oh, and this one. Once you understand this, everything starts to make a lot more sense. But that's definitely not the full story, because expectations naturally have a ceiling. Beating the forecast can explain a good day here or a great week there, but it doesn't shed any light on why the market can beat record after record, year after year, no matter what the world throws at it. Over the last few decades, the way average people invest has completely changed. Back in my day, you or a stockbroker that you paid would look at a company, weigh it up, decide if it's any good, and then buy the shares. Whereas now, it doesn't really work like that, and instead, the money goes into index funds through your 401k, Roth IRA, stocks and shares ISA, or an auto-invest app that takes a slice of every paycheck and buys the whole market in one go. This is known as passive investing, and it now holds well over half of all the money in US funds. It's seen as a very smart and sensible way to invest because, in a lot of ways, it is. But think about what it actually does. Imagine someone walks into the same store every single payday with two objectives. Firstly, to fill their basket with the most expensive things in the store. And secondly, to buy whatever's gone up in price the most since the last time they visited, even if they've already got it at home. I know this is sounding a bit stupid, but just bear with me. They don't check the quality, they don't care whether it's a bargain or not, they just put it in their basket and head to the checkout. You'd probably think that person had lost their mind and maybe call for them to be sectioned. But now picture tens of millions of people who are doing exactly that, automatically out of every paycheck without ever seeing it happen. That's essentially the modern index fund, because an index fund buys companies in proportion to their size. So the bigger the company already is, the more of your money is forced into it automatically. The money flows towards whatever's already the biggest, which makes it bigger again, which then means even more money is forced into it on the next payday. A small handful of giant tech companies now make up around a third of the entire S&P 500. The market hasn't been this dependent on so few companies in over 50 years, and because there's not enough people on the other side wanting to sell, the money coming in has a crazy effect on the price. Some researchers who study this kind of stuff estimate that a single dollar flowing into the market can lift the total value of it by several times that amount, and the effect is strongest on the biggest stocks that the machine is clearly addicted to buying. Essentially, the price is being set by people automatically investing very consistently, and not because the companies are getting better at what they do. To clarify, I'm not saying these companies aren't improving. I'm just saying the money is on autopilot, and autopilot doesn't exactly read the news. On that thought, does anyone actually still read the news? In all seriousness, I've lived through the dot-com crash in 2000 and watched smart people pile into companies that had no earnings purely because the price was going up and everyone else was buying. And more recently, you probably remember the NFT craze that took the world by storm, which was driven by a very similar way of thinking. The difference is, back then it was pretty crazy that people were behaving like that, whereas today, we've built a machine that does it automatically every month. I'm not saying it's good or bad. I still buy the S&P 500 in large amounts very often and believe it's a good idea for others to do the same based on all the historical data. I'm also just raising some concerns because most people don't do that. When a company makes a load of money, it could build a new factory and invest in making a better product. Or it could take that cash and use it to buy its own shares back off the market. Now, I know some of you might be thinking, why on earth would a company spend money buying its own stock? And I hear you, but it's actually becoming increasingly more common. Think about a company's total profit like a pizza, and every shareholder, or in other words, stock owner, gets a tiny slice. If a company buys back more of its own shares, it's not making the pizza any bigger, but it's making their share bigger, which means they keep more of their profits. Essentially, it makes the company's earnings per share go up, which is a number investors obsess over, so the stock price climbs to match. This year, companies are on track to spend around $1.2 trillion buying back their own shares, so investors are happy as they think a bigger pizza just got delivered, when in reality, it's a clever accounting trick that just makes the pizza look tastier. Whether this is the right decision or not is hard to say, because every business is different. But if I'm being honest, I've always leaned on the side that if they spent their money investing in their employees and launching new products, the company would grow in size and therefore the pizza would actually become bigger. But hey, maybe I'm just old-fashioned. So now we've covered a few reasons why stock prices keep rising that have nothing to do with your life getting better, but they're all fairly slow and steady. This next one is full-blown crazy. I have a friend, well, it's more I had a friend these days, but anyway, he was and probably still is a proper gambler. The type of person who spends more time at the casino than he does at work. And he once told me that the most dangerous time in a casino isn't when you're losing, it's when the whole table is winning. Now, I can't relate to this because I'm notoriously known for only doing $1 bets, but when you think about it, it kind of makes sense. Everyone's up, the chips are stacking, drinks are flowing, and not one person at the table is thinking about leaving. Now, before anyone comments saying, "Mark, this is meant to be a video about stocks, not gambling," let me explain. The reason I'm telling you this story is because the market has built itself a version of that exact moment. It's called zero-day options, which sounds confusing, but basically you can make a bet on where a stock is going to be by the end of the day, and that option expires the same day. In fact, this kind of trade now accounts for around half the daily options linked to the S&P 500. If loads of people are buying options betting that the market is going to go up, someone has to sell those options, and often that's a market maker. But the market maker doesn't necessarily want to bet that the market will go down. They're just taking the other side of the trade. So to protect themselves if the market does go up, they can buy exposure to the S&P 500. That's called hedging. The thing is, as the market rises, the amount they need to hedge can change, meaning they may have to buy even more. Basically, the market goes up, more people see it going up and place the same bets. Those firms may have to buy more to hedge themselves, and that buying can push prices up again. But none of it necessarily has anything to do with whether the companies are actually worth more. It's just money flowing through the system and moving prices around. But what happens when the market stops going up? We got a pretty extreme example of this back in 1987 on Black Monday, when the stock market fell more than 20% in a single day. Part of what made that crash so crazy was that some of the same strategies that were designed to buy or hedge in a rising market were suddenly selling into a falling one. And as you can imagine, that creates the opposite effect. Prices fall, people sell, that selling pushes down prices even further, which then creates even more selling. So you can have a system that helps push the market higher on the way up, but then accelerates the fall when things go bad. But to me, this raises an obvious question. Sure, these are all great reasons why the stock market can keep climbing despite the economy not doing well, but they all require money. So where is the money coming from? For well over a decade, the world has been flooded with cheap money. After the financial crisis and then again in 2020, central banks and governments pumped ridiculous amounts of money into the system and held interest rates near the floor for years. When your savings in the bank are paying you basically nothing, which is the case for most people these days, unfortunately, naturally, you look for somewhere to invest it like stocks, property, gold, and Bitcoin, which drives their prices up further. This is great if you invest, because as I've said time and time again, investing is one of the best ways for ordinary people to build wealth over the long term. But when you look at the data, who do you think had the spare money to invest? Sadly, it was the people who were already wealthy. So that flood of cheap money didn't go into wages or shopping baskets in the real economy where most people live. It went straight into the laps of the people that were most likely to invest it, inflating the price of owning assets while barely touching the amount you get paid for doing a job. A lot of people will say the market is only high because interest rates are low, but that just isn't the case anymore. Rates right now are actually a lot higher than they were in the cheap era, so low rates on their own can't be the explanation for today's market. What really happened at least in my opinion, is that the money already got in and flooded the system years ago, lighting everything we've discussed so far, and now it's just running on momentum. But at the same time, I think inflation plays a big part, because when people are scared about it eating away at their savings, they don't want to leave it sitting in the bank losing value, so they pull it out and push it into assets to protect what they've got. Essentially, fear becomes the fuel putting more money into the system for no other reason than not wanting to be the one left holding cash. The benefits of a rising market aren't spread evenly, and whether you already own assets or not is more important than ever. If you own stocks or property, for example, rising asset prices make you much richer without you having to do anything different. But if you don't own these assets, you experience the same economy very differently because the goalposts just keep moving. You're watching house prices rise while trying to save for a deposit, and the more expensive everything becomes, the harder it is to get started. The richest 10% of households now account for almost half of all consumer spending, which is nearly 1 in every $2 spent and the highest since records began in 1989. So when you hear the economy is strong, what that actually means is the top 10% are out spending, feeling rich and confident because their portfolios keep climbing, while everyone else is having the ladder pulled up as they try to climb it. Look, I'm of course a wealthy man. I've worked very hard for my money, invested it strategically, and used compound interest to grow my wealth over time. Saying this, it's still a shame to see this divide, which is why I'm telling you that a record high is only a win if you own assets, and for everyone else, it's the finish line moving further and further away. Which brings me on to the only question that actually matters. What can you do? I didn't start life on the winning side of all this. In fact, I started with nothing of real value, apart from a loving family. I worked for every single penny the same way maybe a lot of you watching this are. Now, I'm not going to tell you exactly what to go out and buy because that's not my job, and it never will be because I'm not a financial advisor. But what I will do is tell you exactly what I did. I spent less than I earned, even in the years when it felt impossible to do so. But at the same time, I worked like mad to earn as much money as I possibly could, because there's always a cap on how much you can cut back on and save, but there's no ceiling to how much you can earn if you apply yourself in the right areas. And then slowly, and to be honest, boringly, I used that money to become an asset owner and stopped only working for money by letting my money work for me. I'm not going to insult you by pretending any of this is easy at the moment, because it really isn't, and the goalposts really have moved. But it being harder is not the same as it being impossible, and the system isn't going to wait around for you to feel ready or pause when times get tough. It's more than likely just going to keep rewarding the asset owners. So the next time you see stocks hit a record high while the world is on fire, hopefully you won't feel a big disconnect between the news and your everyday life, because you'll finally know the answer to the only question that actually matters. Record highs? But for who? Well, hopefully you. If you want to understand what always happens just before a market crash, then I'm going to leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to stay ahead of everyone else. Okay? I'll see you over there.